Hello, everybody. It's Mark Pruitt with Strategic Estate Planning Services. I hope you're doing well today. Boy, January has been a very interesting month. So with that said, I'm going to jump right in. I want to give you an update in regards to markets, kind of what we're doing, what's happening with inside of your accounts. So if you need to, grab your paper and pencil. We're going to take some notes, and I'll make sure that I give this to you in a good, succinct video. But before I do that, just in case, I'm going to have Laura put on the screen for you the place that you can go to and order your 4 COVID tests for free that they will send you. I tried to do that. Believe it or not, Della beat me to it already. And she had already ordered it. And actually, I put in my address not knowing that. And it popped back up and said, you've already ordered your 4. So it even tracks that. So that's interesting to see. I tested it, I guess, not even knowing I was about to test it. But bottom line is, check what is coming up on your screen to make sure you know where to go to order your 4 tests. And that's 4 tests that you don't have to buy, and they should come to your house, I believe, via U.S. Postal Service. So I'll be looking for mine as well. So just keep that in mind. Now, in regards to markets, obviously, inflation is still continuing to go. We're waiting for February. We'll know in February what January numbers were. So it's interesting. We thought we were at the top in November at about 6.5% for inflation. And lo and behold, here comes January numbers for December, and now we're at 7%. So inflation is continuing to move forward. Somewhere down the road, it's going to get over the hump, and it will slowly and gradually begin to deflate, and you'll go into a de-inflationary period. We're just not there yet. So because of that, and then you hear the things for what the Fed's talking about, which is open and public, and on videos and news stations all over the country and national news, local news, you can hear that they're looking at raising interest rates sooner than later. So because of that, you've got all types of things that are being factored in. The Fed, I can tell you, the Fed fund rate is now factored in for interest rates for this year. Whether they do that or not, whether they do more, whether they do less, the market in January has factored in 4 interest rate hikes this year alone, which is earlier than expected in 2023. So markets are making that adjustment right now in January. There's a thing out there called the VIX, the VIX. You can put it on your phone, you can track it, you can look it up. That is the volatility index. As that volatility index gets higher, being as in you get from between 20 and 30, you start having choppy grounds. You get above 30, you start having market downturns completely. We're not there in that regard, but I can tell you things that we are already out of and have already made shifts in regards to your portfolio. So let me give you some of those first. First ones, we are out of the NASDAQ. We are out of the Russell. We are out of tech. So QQQ or XLK, that have a lot of different tech companies. Why are we out of those? Because they have broken trend. A trend is at least 3 months. And they have broke that trend, believe it or not. So that's important to know. I can tell you right now, yesterday, this week, SPY, which is basically the S&P, broke trend after 18 months of going straight up. It is now broke trend. Once that happens, things begin to get wobbly in regards to certain securities and certain sectors. And so what that means for you is the following. There are some things that we were in last year that were growth. Growth does real well when everything is moving forward. That's what you want. That is now changing. Tech stocks are growth, as an example. Small caps, mid caps, the Russell, the NASDAQ, which is tech, are all growth oriented. Those are all changing now. And so where we are shifting to are things that are value oriented. What are things that are value oriented? Things such as consumer staples. People are still going to buy groceries. They're still going to buy things at the drugstore. They're still going to do utilities, as an example, another one. They're going to keep the electricity on. They're going to keep their homes heated and cooled. They're going to talk on the phone. there are things that are more defensive and do well when markets begin to adjust, where they don't do well in growth cycles. So the utilities last year wouldn't have done very well. Consumer staples wouldn't have done very well. We're not talking about it. We're already making the shifts. We've already de-risked many of these things, such as the S&P. We're already have reduced our position by 50%, and we'll continue to reduce more. We'll go into some things such as gold that are beginning to move forward now, because gold doesn't do well when markets are going up. Gold doesn't do well. Well, what's happening? Markets are starting to trend downward, and so gold begins to move forward, and we'll begin to layer in some of that along the way. So those are the type of things. I can tell you certain bonds as well will not work in this environment. Other bonds do work well in this environment. So we're making those shifts as well within your portfolios. So, we can't predict all of that, but we can de-risk a lot of it. And we know that when the trends break, that's a pattern. And when the patterns show that, you don't want to sit on what you've got. Makes a big, big difference. So we're making those shifts for your portfolios already. I can tell you in regards to inflation, and this is going to be interesting to see in the February numbers, commodities are actually starting to go down. And I don't mean some of them, I mean a lot of them, such as, believe it or not, cocoa, coffee, coconut oil, wood. Those are things that we all use at time, along with a lot of other commodities, and they're not continuing to go up in price, they're actually deflating. And commodities are usually the first thing that will start to deflate when you finally have gotten over the hump of inflation. So we're watching that and tracking that, and we're watching that as far as understanding that supply chains are still tight. We are not done with this. I still think it's going to take us minimum this year and probably into next year in regards to the supply chains, because it's so broad, it's global. Everybody's still ordering things, so we see that people are spending, but it takes time to get the goods. I had a client literally last week said he was ordering a car. He's actually already ordered it, and they told him that car would take them 6 months to build because they have no new cars on the lot, and the price was a lot higher. I think he said originally it was $30,000, and it's now $50,000. And so big difference in regards to a car. So just keep those things in mind. In regards to supply chains, we're not done yet, but things in some areas are looking better than others. And so just know that we're looking at the ranges every single day in all of these areas. There is a high and a low range of each one of these things. So whether it's value, bonds, commodities, gold, whatever it is, we're watching those daily, and we're already making adjustments. I mean, we're not talking about it. We've made them, and we're going to continue to make them, and what we call layer out. We're not going to cash. We're shifting the tool from growth-oriented things to value-oriented things, and that helps hold water when you start getting markets that are choppy and begin to correct. We will say this year, or this quarter, we think it's come a little quicker than what we thought it was going to come. We said it was going to be a narrowing in quad one, or narrowing in the first quarter, and then going into a red zone in the second quarter. We're going to probably get there earlier than expected, and so we're making the moves. We're not waiting. We're going to pivot right now. We're already doing that. So I want to give you that update just to make sure you're aware. If you have any questions in the future, please don't hesitate. Call us. You're welcome to call me. Talk to Lamar. Talk to Stephen. I'm on calls every day for at least an hour in regards to measuring these tools. And we're looking at it on a daily basis, and then we're beginning, when we see these trends change, we're making the change with it. We're not waiting. So appreciate your confidence. Appreciate your help and your faith and trust in us. We're always honored to serve you and your family. If you need anything at all, don't hesitate to call. We'll look forward to talking to you soon. 1-800-381-8870. God bless.